this is John. Hope you're excited for a super special episode of the Stock Market News podcast. Before we started, there's one thing I kind of sort of forgot to mention, but it was also kind of implied, and it's pretty basic. It's just this idea that if I have my aunt, for example, she bought like a ton of Tesla when it was like 70 or 80 bucks before the recent split, which is the equivalent of like basically 20 bucks a share, versus the current like I don't know 500 or so. And there's this really obvious example of like if someone buys a stock at 20 bucks and it goes to like 400, say. Like if you sell it at 400 and then someone else buys it at 400, and then it like goes to 500. Like you theoretically like missed out on some money, but you still made an incredibly large amount of money. So it's not like a zero sum thing because you made a ton of money. Similarly, if you like short a stock at 500 and it goes to I don't know 100, and then you exit it and then it goes bankrupt, like you miss out on some of it for sure, but it's not like a zero sum thing because you still have the vast bulk of it. And so the thing where this really starts to come to an effect is if you buy at say 20 and then it goes to 200, and say that it goes from 200 to 180 and you sell it 180, and then the other person buys it at 180 or whatever, right? And then it goes up a bunch to say 250, and they make a bunch of money, and you like didn't have the money, but it's not like you lost money selling it to them, right? Like you still lock in your profit, and that's one important factor that's going to come in, and really we're going to look a lot in this episode about the idea of paper value, and also hedged paper value versus actual performance of an asset, and of course performance of an overarching portfolio, and a couple of little nuanced concepts like that that really disproves something I've been hearing a lot lately. So anyway, with that said, I'm gonna get much more into detail once the episode starts. I just kind of had a caveat here I wanted to put beforehand. So yeah, thank you guys so much, and I'll see you in just a sec.
So the big question is this: how do investors like us who don't have a PhD in finance or millions to start investing, how do we grow our bank accounts to build real savings in retirements and yet still have the time to do what we really love? That is the question, and this podcast will give you the answer. Hey guys, it's John. Hope you're having an awesome day. I had a pretty crazy thing happen today. I've been following, let's see, what was it? I always forget the tickers. Odd US for, there's been this nice setup for a week or so. And, God, I learned this lesson today. It was the worst thing ever. I've been following this thing for such a extended period of time. And, I've done nothing for the past couple of days but just stare at Australian dollar. And, I go to lunch with my dad at 1:30. I get back, and the setup I've been waiting for had completed when I was gone, and I totally freaking missed it. I felt so silly and dumb. And, I don't know, just kind of ranting. I kind of sad about it. I missed out on like 40 grand, which honestly kind of sucks. So I'm just kind of sitting up thinking about that, thinking about priorities and all. And while I was doing that, this epiphany kind of came to me about something that I hear and I had heard very, very recently, that I hear all the time, and it's like literally the weirdest thing I've ever heard. It's on par in terms of intelligence level as stuff like you can't beat the market or, the market is efficient. It's like that kind of level of, understanding of financial markets. And what it is that, the market is a zero-sum game. And, that makes no sense whatsoever, and it's like utterly false, and it's insanely stupid, and yet there are a lot of people that say it, and I could never figure out why. Like, you trade for like 3 days, and it's like, oh yeah, I guess that's how it works, but it's like so many people don't even know, which I think is crazy. So I want to talk about that today. Just to kind of clear it up, because I know some of you might be starting out, or maybe some of you started very, very recently. And anyway, I think it's a really great and very important thing to clear up, because what it does is it allows you to go from a scarcity mindset of, you making money comes from other people losing money, which is not true in any means of that being a thing, and instead transition into an abundance mindset where you realize that there are literally trillions and trillions and trillions of dollars in financial markets, and there are trillions of dollars being created and generated, all of the time. And so there is a complete and total abundance of money. If you think about it in terms of market growth, the whole market average rate of growth over the past, century or so, is what, like 10, a little over 10%. So like on average, that's 10% growth in a $1 trillion market. That's trillions of dollars on average generated nowadays every single year just from appreciation of assets. And so it's like essentially generating value out of thin air, which turns into its equivalent in money. And that's only further supported nowadays by the massive printing of dollars from the Fed, which therefore, it inflates asset prices just by nature of how inflation works when central governments print money. And so anyway, coming back to our topic, this idea of, and this silly idea that, the market is a zero-sum game, your trades are a zero-sum game, blah, blah, blah. And even I thought this when I first started trading leverage currency futures. I was like, oh, okay, this is, a lot of times with, when I was starting out, I was trading with CFD brokers in terms of stocks and in currency futures. So with those guys, you basically trade against a central broker that sells contracts. And there are some versions of CFDs where you essentially risk all of your capital with an upside gain of about 60 to 80%. And in those scenarios, you're like basically going to I don't want to say a casino because it's not the same as that, but it's very similar in terms of you'll make like a bet, like a currency or whatever is going to be up or down, in the up or down, and like that's it, like up or down in the next hour, or maybe sometimes it's 5 minutes, sometimes it's 30 seconds, sometimes it's 15 minutes, sometimes it's 30 minutes. Like that kind of stuff is to an extent a zero-sum game, in the sense that in the long term, with most, not all of it, but with most of those kinds of contracts for difference, it is it's just exceptionally hard to succeed because it removes excuse me, removes one of the most important parts of good trading, excuse me, which is a high risk reward ratio, and instead it gives you a 0.6 to 1 risk reward ratio, which is really, really bad, or something around those parts. And with the 50-50 trade, in the long term, that's not going to do very well. What I'm talking about is general, actual open market trading, where you're not like playing some silly game with a central broker. You're not doing some crazy CFD. Most CFDs are illegal in America anyway. But you're not playing some asset that's designed inherently to make a broker money and take it from you. Instead, what I'm talking about is just any generally traded public security, like a stock or an option or currency or whatever. And that's where I hear this phrase a lot. People saying, it's a zero-sum game. Oh, if I buy a stock at 20 and it goes to 30, then the guy that sold it to me, missed out on money. Maybe he was short. Maybe they lost money. Or similarly with currencies, you sell the Australian dollar, for example, or I bought the Australian dollar. So say the guy who sold it to me had to sell short maybe, or maybe he just sold it and then he lost out on all the money when it went up. So you hear that argument a lot, and at the end of the day, like, that's a ridiculous argument that makes literally no sense. So let me walk you through an example, just one example, where it makes literally no sense. So first of all, hedge funds started in the 20s, I believe, somewhere around that, 30s. The 30s. So the whole idea behind it was, you would have investments, and then you'd also have other investments that hedged against the risk of those investments. And you accept that you'll have a lower return in exchange for decreased downside volatility, etc. And that was the basic idea when hedge funds started. And all the people really did was buy gold mostly, and then buy indices. And they understood going into it that they were going to lose money on gold a good chunk of the time. And they were cool with that because it would offset when the market went up versus, because the gold, historically generally kind of goes up when the market goes down, and we've seen that recently. So they were like totally cool with losing money on gold because they knew that this other part of their portfolio would do better. And at the same time, they knew it was decreasing their volatility and increasing their Sharpe ratio. So that's one example where you look at one side of the trade. If you look at only the gold side of the trade, it's like, wow, this is stupid. I'm selling them gold and they're buying it and the price is going down. There must be like losing tons of money. But in reality, it's part of an overall strategy to reduce volatility, and they're actually crushing it in the market. Now that's one very, very basic example of using it in terms of a diversified portfolio. Now it's a little bit silly, and nowadays it's a little bit, at least for me, it's not like something I would like to do. Like I would rather just pick assets that I know are going to do well. Like recently, I shorted the market in February and was in gold earlier before that. And so that's kind of more so what I do now. But that's just one example. So here's another example, okay? Let's say stocks hit 50 and I've been holding shares since 30 or, whatever. And I sell at 50 and say some dude buys it, okay? Now, here's really one of the most important things to realize about any trade. And it's that, like, you don't have to hold the trade forever. So if the person who buys it from me at 50, sets a stop loss at 49, and then they get stopped out of the trade, like, they have limited downside if they're using a stop loss. Like, it's not a big deal, right? But let's say, for argument's sake, that they don't get stopped out at 49, or they just keep holding it, or, whatever, right? And let's say it goes down, it goes down, it goes down, it goes down, and it goes down all the way to, 40, okay? So they bought it at 50 and it went down to 40. On paper, let's say they lose money on that part of the trade. But similarly, let's say they were only buying the stock to offset some of the risk on, say, out-of-the-money puts. Or maybe they were selling the call, so they sold covered calls. So maybe they got, $5-7 for call premiums with high volatility, or maybe they made 80, 90, 150% on puts, and they just had the underlying stock as kind of an insurance in case it went up, and the puts were really the play they wanted to make. That's a very common thing to happen when you have maybe less, because what it does is it removes volatility. Instead of making just a naked call sale, or instead of making just a naked put buy, you can reduce a lot of the volatility by buying the underlying stock. So it looks like you lose money on part of the trade, but in reality, your overall gain is massive, right? And that doesn't even begin to account for the fact that you can always stop out of a trade if it's not going your way, and have someone else with a different perspective on the market come in and take that order, or even just a market maker take that order. That's a really important part too. You have to realize a vast bulk of trades aren't actually going to people. They're going to market makers, right? And they're being held for a matter of seconds often, or maybe a couple minutes. And so as you have these flips between bids and asks and all, I guess spreads are maybe one of those gray areas. But I think everybody benefits from spreads because, at least in most markets, you can always buy the bid and sell the ask. So I wouldn't say that's a huge directional bias in terms of a zero-sum game. But the point is that there's always a lot of different ways to frame your trades so that even if you have a quote-unquote losing trade, it isn't a losing trade. And similarly, it's not fair to think of you selling someone a stock for a huge profit as a loss. Like, for instance, let's see. I think this was with AMD. So I bought AMD at 10 or so, maybe 9, 8, something like that. Maybe a little bit of it in the low teens. And then I went and I sold a ton of it at 35 when they had this huge spike up. Or maybe it was 32, right? And so they spike up to 32 and then they drop down back to 20, and I kind of buy some more back, half the additional position, which had already tripled. And then the thing runs up to 80, So do you think that the person that bought it at 35 would be pissed when it dropped down to 20? Yeah, sure they would. But are they going to stay pissed when it goes to 80? No, right? So, you have to look at time frame too, because a lot of times what people see as a losing trade, isn't. A great example of this, I feel so bad, and I'm so sad talking about this, because a lot of people I know that, bubbles are just such an interesting topic, and I would love to do a whole episode on bubbles. Especially, I think I did an episode earlier on. One of the first episodes I did was on the emotions of the Bitcoin bubble of 17. And that's a real good one. So I would go back to the start and listen to that. Or maybe if it's not on the podcast, go to YouTube and listen to that. But anyway, there's a lot of really incredible emotions going on back then. And I remember my dad, he wanted to get into crypto, and I was like, okay, yeah, I'll help you out. I am not going to say no to a client. So he buys Bitcoin at 12,000, 13,000. And for like the past 2.5 or so years, it's been like, in the red, down 80% some near 80%, 70% at one point, in terms of his position. And now, it's just starting to climb back up at 13.5 now. Who knows what it'll be when you're listening to this? 13,500. So he's over cost basis and now netting a profit. So like in the short term, it was like a really, really bad investment. And whoever sold it to him, did a good job selling. But in the long term, it's like, oh yeah, would you look at that? Same thing if you look at the people that sold Amazon at its peak in 2000 versus what it's worth now. Like, you might have had to wait a decade and a half, but if you did wait a decade and a half, even if you bought at the absolute worst time possible, when people would have said that you have lost a ton of money, that's still you're 10xing, 100xing from those peaks. And so a lot of it comes down to perspective, and that's basically the gist of what I want to come to you with today. Is that the market is not a zero-sum game. It all just depends on your perspective. That is an excuse to not perform well, and it's a stupid one at that. It literally makes no sense, especially when you can play either side of a market, make money when stocks go up or down, on leverage or without it. It's just incredibly dumb. It's just really crazy. So that's my little thing today. I hope you guys had some cool realizations today. I hope it maybe opened up your eyes to a couple of ways to mitigate risk in your portfolio, if that's what you're all about. I hope you have a really, really awesome day, and go out there, apply it, absolutely crush it, and I'll see you guys later. Oh, something kind of interesting. I have this one client. They all they do is sell puts, and calls and puts. They sell calls and puts every single day on a weekly time frame. They have a 98% success rate. And of course, that means it's going to be 2% of their trades where they lose, a decent chunk of change. And on those investments, it's like, oh, well, look at that. The market is, the market takes money from them. Oh, zero sum. But at the end of the day, when you have an effective trading strategy, dude makes like, I don't know like how much detail I want to go into, but I mean, it's like, yeah, I don't know, 6 figures. I mean, it's a lot of money. And I don't know, like once you have effective trading strategies, it like literally becomes stupid to think that it's a zero-sum game, because like it's not. But I don't know, it's just something that came to mind, and something I thought of at first was like, if it really is like a zero sum, then that would mean that everyone that's successful is alienating everyone that's not successful, if it's a 1-to-1 ratio of success to unsuccessful, and thereby in the long term, i.e. over the past 100 or so years when financial markets have been in existence, like everyone that isn't good and loses money would leave, and then there would be no one to make money off of. But lo and behold, that's not the case, and a vast, I can't stress this enough, like 90% of money is not individuals, it's institutions. A vast bulk of capital in the markets continues to trade because there's alpha to find everywhere you look, and there's just always opportunity, and ways for everyone collectively to succeed. If I convince 1,000 people in a room to go buy some weird penny stock and then dump it later, like everyone there's gonna make money. People that buy it later might have a tougher time making money with it, but they can cut their losses quick, or they can hedge their bets, or at the end of the day, you hold it from 10 cents to $15, and the other person buys it at 15, sells it at $14.50, like that's not a huge deal, right? And then you've got the upside of going to 20 or whatever. Kind of a convoluted example, but another one nonetheless, where you have disproportionate risk-reward ratios once you have proper risk management, and it just creates a lot of opportunity. And when you have opportunity, like, that's not a zero-sum game, and that's really what I mean. I feel like once you start trading pre-market gainers, you see this so obviously, where like you have stocks that just keep going up and up and up and up and up, and it's, it's like, gee, well, let's see, I could buy it and then just, like, sell it, and then I think I did pretty well there. And then when you see stock prices going down, like, a lot of times what that is people shorting it, right? And so they'll borrow the shares against a broker, against some dude who's holding it in the long term, and gets like a 0.4% rate on lended out shares, or no rate on lended out shares. And so it's just people making money shorting it. And if you have like 70% of the market buying, and 70% of the market making money, and then you have 70% of the market shorting, 70% of the market making money, like, that's not a zero-sum game. So yeah, I don't know. Big thing to notice there. You'll see this a lot if you look at the call put ratios on a given asset on any day. You'll see like a bias towards calls if the stock's up, or a bias towards puts if the stock's down. And so if you have more people buying, like, that's a statistically significant percentage of individuals that are making money over those that are not, in terms of that one specific hedge on one specific asset. When you have a whole portfolio of those, it just becomes easier to remove correlation, and thereby increase overall long-term returns and stability, and obviously decrease volatility. So yeah, I don't know, really interesting, and just something I've never heard a lot of people, never really anybody talk about. And I think it's incredibly stupid, because it's one of the biggest myths I hear. So yeah, thanks guys, and have a awesome day. Bye. Want more stock market secrets? If so, go get your free copy of my best-selling book, 9 to Noon. You can get your free copy plus $11,176 of unannounced bonuses it took me years to uncover, completely for free at 9tonoonsecrets.com. Inside 9 to Noon, you'll find the top 38 secrets you can use to double your portfolio every 2 years and make upwards of 10% per trade daily.